Why does the banking system create inflation? Imagine a busy marketplace where everyone is eager to buy the latest gadgets. Now picture the banks as the shopkeepers who lend out money to people wanting to buy those gadgets. When banks lend more money, they are creating new purchasing power. This process is a big part of how the banking system can lead to inflation. Banks don't just hold onto deposits, they issue loans to individuals and businesses. When a bank approves a loan, it credits the borrower's account with money that didn't exist before. This increases the total amount of money in circulation. Think of it like adding more water to a sponge. The more water, the more pressure or demand there is. This extra money makes people more willing to spend. When consumers and companies have more funds, they buy more goods and services. But if the supply of these goods and services doesn't grow at the same pace, prices start to rise. That's what we call demand pull inflation. It's like a sudden rush of shoppers in a store with limited stock, pushing prices higher. The multiplier effect is another way the banking system fuels inflation. When one person spends money, that money often gets respent multiple times. Each round of spending creates more demand, further pushing prices up. Central banks try to control this by setting interest rates. When they lower rates, borrowing becomes cheaper, encouraging more loans and more money creation. Higher rates make borrowing more expensive, which can slow down inflation. Banks also influence inflation through asset prices. When they lend a lot of money, it often flows into real estate or stocks. This inflates the prices of these assets beyond their real value. When asset prices go up, people feel wealthier and spend more, which can push consumer prices higher too. In a capitalist system, banks aim to make profits by lending. This naturally encourages more credit, which boosts economic growth but can also cause prices to rise if unchecked. Central banks step in to balance this by adjusting interest rates and reserve requirements. But overall, the more banks lend, the more money there is in the economy, and that can lead to inflation. So, the banking system creates inflation because it expands the money supply through lending. This extra money increases demand, and if supply doesn't keep up, prices go up. It's a key part of how financial systems work within capitalism, linking credit to rising prices.